At a moment when global financial tensions are tightening like a storm on the horizon, we are now confronted with two urgent developments that threaten to reshape not only the global economy, but also the value of our money, our purchasing power, and ultimately the sense of growing financial insecurity that millions of people will experience in the years ahead. So we have two urgent updates to make, and it's going to affect not just the global economy, it's going to affect our money, our buying power, and how we will all feel poorer in the years to come. Now, by now, we know the urgent situation the U.S. is in. The trade war is hammering down on major industries. The race against China is going to get worse, and trying to reshaw factories isn't going to be cheap, and that means a lot more money has to be spent, but it can't be done sustainably anymore. This is no longer the post-war U.S. that was rich with gold and a very big production base. The national debt today is reaching an exponential disaster. In just 25 years, we have gone from 6 trillion in debt to over 38 trillion. That's a 7 times increase after the big bailouts in 2020 and 2008. Every time the debt goes higher, it releases a huge amount of money into the economy, money that shouldn't be there, money that pushes up the price of everything. This is not sustainable. When interest rates went up in 2022, we started to enter a different crisis. The national debt blew up, not because of a new QE, but because of the existing burden. Now, we have reached a point where the snowball effect is undeniable. The boulder is going to roll down the hill and crush the city below. And there's only one way out of this mess. U.S. interest expense is now officially higher than defense spending. It's more than health spending. At this rate, by the end of 2030, it would very easily exceed Social Security. And this means the entire U.S. economy is living on board time. The U.S. budget will be used to pay back bondholders. It will be a nation of debt slaves where taxes are used to pay back all the creditors. Now, can the U.S. default on the debt? How about declaring a debt jubilee and writing everything off? Now, this is a tempting idea, but it's not feasible. Wall Street won't be happy. Asset holders will revolt, and foreign countries like Japan and China, well, they're going to be pissed off. And this will break the entire U.S. bond market for generations. No one will ever want to lend Washington money anymore. So that option is out. It's as crazy as the trillion-dollar platinum coin idea. Now, to prevent a debt implosion, to kick the can down the road, Trump only has one solution left. He has no choice but to drop interest rates down. That's the only lever Washington has left the pull. Now, interest payments today have exceeded $1 trillion annually. That's over half of the deficit in 2025. The average interest rate on a national debt is 3.36% today. There is a reason why Scott Bessent is moving all of his bond issuance to short-term treasuries. He is coordinating with Trump to push down short-term rates to flood the world with short-term bonds. And to make this happen, Trump will need to populate the Federal Reserve with his own people. Now, the moment Stephen Moran became a Fed governor, it was game over. The plan was always to slam down interest rates, push all the bond issuance towards the short end of the curve, and that will release pressure on long-term bonds and hopefully prevent the real economy from collapsing. Now, Trump just confirmed this with his biggest hint on the new Fed chair, and that is Kevin Hassett, who is maybe the biggest dove in the administration, being it's a great group, and I guess a potential Fed chair is here too. I don't know who's allowed to say that potential. He's a respected person, that I can tell you. Thank you, Kevin. Now, we have to understand the enormous risk here. Every time a short-term bond matures, it will need immediate refinancing. Interest will be paid back at shorter intervals, which grows the money supply even quicker. And if confidence collapses, investors will refuse to roll their money back. Suddenly, the government is on the hook to finance their spending. The Treasury will need cash. The Fed will need to step in and monetize, has definitely step up, buy up all the short-term bills, which is classical money printing. In other words, Trump has pushed the U.S. economy closer towards a confidence collapse. Now, the plan is to slam rates here close to 1% or lower so Bessent can refinance the U.S. debt at lower rates. The deficit will also be borrowed here, but that does not mean long-term rates will go down. If confidence collapses, it does not mean investors will immediately buy a 10-year or 20-year U.S. Treasury bond. If you don't trust U.S. debt for 3 months, you would be insane to lock your money for 10 years. It just doesn't work that way. But the cards are going to happen. Now, the administration's playbook is to deny the very existence of inflation, because if you don't speak about it, it doesn't exist. And if inflation doesn't exist, you can drop interest rates to the floor. It's like Voldemort and Harry Potter, you don't talk about him. And yet, some prices are going up. Of course, we have seen prices increasing on staples like coffee, bananas, bacon. Inflation has gone up. It's at 3% now, up from 2% in April when the tariffs were imposed. No, 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 no. They weren't. So inflation hasn't gone up. And Kristen, the one thing that we're not going to do is do what the Biden administration did and tell the American people they don't know how they feel. They are traumatized. And over the Biden inflation, but therein lies the problem. Inflation is extremely sticky in the US. The tariffs are raising the cost of living to crazy levels. The inflation numbers are out, and these are just for September, and it already shows us consumers are starting to break. Overall inflation today is 3%. Wholesale inflation has risen to 2.7%. That is how much producers are suffering. Sooner or later, this number is going to rise and push up prices for consumers as well. Retail spending has fallen by 0.1% after we factor in the price increase. So the numbers of strong spending has to be taken with a pinch of salt. Consumer confidence in November has also plumed to a dangerously low level. People are just treading water today. When interest rates fall in 2026, there is the risk of a new inflation wave hitting. And because Trump has strong influence over the Fed, there might not be a rate hike. And let me repeat myself. All the Fed needs to do is revise the inflation target upwards to 3% or higher. And we are going to have a new normal. There won't be a need to hike rates higher when everyone now expects hotter inflation. Now, the situation just got worse. Just a few days back, the Fed made two moves that signals the money printing era is coming back. POW has injected over $13 billion into the banking system. This is the biggest liquidity bull since 2020. It shows us how stressed the entire system is for cash, especially when everyone needs money for the AI bubble. This won't be the last time. But a bigger crisis comes with the Fed ending QT, or quantitative tightening. In other words, the Fed is no longer selling their holdings of U.S. Treasuries for cash. They're going to sit on their pile of debt and allow money to flood the real economy. Now, as we suspected for years, the Fed was never going to drain their balance sheet completely. It was impossible. The economy needs the money supply to constantly expand, or everything is going to collapse. But it also means the huge glut of money in the system is not going to disappear. When the Fed sells their bonds, the money that they get from the sale simply gets deleted. Now, simply put, the Fed creates money and deletes money from thin air. And because QT has ended, there's now an additional $2.5 trillion in the system. Before the pandemic, the Fed's balance sheet stood at under $4 trillion. It's over $6.5 trillion today. It's not very complex to understand. The Fed was supposed to drain away this excess liquidity to prevent an inflation explosion, but it simply can't do it now. If money gets drained away, who's going to buy treasury bonds from the U.S. government? How are investors going to pound money into all those data center buildouts? This pivot is extremely important. It's a signal that dollar debasement is coming back. Worst of all, it is an admission that U.S. money supply is going to expand in an insane manner in the next few years. When QT ends, the Fed is going to stop pulling out a lot of money from the system. It's not a trivial amount, and it sets the stage for future quantitative easings coming up. Now, before the pivot, the Fed was pulling out up to $100 billion from the economy. That's $60 billion from treasuries and $35 billion from MBS. That's $100 billion getting deleted from the system. And when you shrink the money supply, that should bring down inflation. After all, there's fewer dollars chasing the same amount of goods. But that can't be done anymore because of the tariff war, the AI race, and the supply chain crisis. The U.S. has to expand the money supply. There needs to be more liquidity in the system. But this would also mean inflation is going to heat up. And let's just start with consumer inflation first. This is the upcoming fat chair trying to defend the indefensible Thanksgiving. If you're going to the store to buy groceries for Thanksgiving, it's going to be more expensive. This I really don't understand where you're going, in the sense that Joe Biden gave us 20%. He's not president. Donald Trump's president. No. And you want us to fix the hole that Joe Biden. Why does the president tell the prices went up so much under Joe Biden and inflation is way down? Inflation is about half what it was in December. This is something that's being fixed fast, and real incomes are up after dropping about 3,000 under Joe Biden. Now, this is bargain level basement deflection. It's not even elegant at all. The blame game here is just getting embarrassment. I give this one a D grade now. But once again, it's the denial that inflation is a problem. When you drop rates while burning through nearly $2 trillion in annual deficits, the amount of cash in the system is going to explode. It will trickle down to everything, including products in Target and Walmart. The excess cash will soak up goods in the US before slowly spreading to the rest of the world. So whether you're in Australia, Singapore, London, Riyadh, prices are going to heat up in 2026. But a big shock will likely come from asset prices. There is an enormous amount of cash just waiting to be released, like a tsunami hitting the shores. There's over $8 trillion in U.S. money market accounts. That is a mountain of money invested into short-term U.S. bonds. It's so much that the dividend payments hit a record $500 billion a year. Now, what happens when the Fed cuts rates in 2026? Holders are getting paid 3.5% of their cash sitting in the funds. And when that gets lowered to 2% or even 1%, the incentives to stay in money markets evaporates. There could be a big exodus of money living. You'll start entering all sorts of assets, and this could include equities, Bitcoin, and of course, gold. Even silver will absorb some of this money tsunami. So barring a recession, 2026 could be another bullish year for asset prices. Now, I'm not saying that it's a good or bad thing, but it's just how the mechanics work. Here is the tragic part. The U.S. is already within the top 10 inches wealth inequality. It's higher than China and even India. And what do you think will happen when inflation rises and asset prices go through the roof? The poor will get locked in while the middle class will get hollowed out. Now, I don't like what's happening, but the collapse is going to get worse next year. Now, is there a way to reverse this? I don't think so. The U.S. is trying to juggle too many things at once, and the only way to even stand a chance is to inflate the pain away. Easy money is coming back. There is no stopping this train. But let me know what you think. Will the Fed aggressively cut in 2026? And how much further can the dollar plunge? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through this crazy times.